In the hallowed halls of Wall Street, a specter looms large on the horizon: the return of the debt ceiling in early 2025. Financial analysts are already placing bets on when the United States government will exhaust its borrowing authority, with forecasts converging around July or August. For ordinary Americans, this may sound like an abstract concern, but for those steeped in the intricacies of financial markets, it's a harbinger of potential turmoil. The immediate focus, of course, is on Congress's need to avert a government shutdown by the end of this month. However, the real concern lies in January 1, 2025, when the current debt ceiling suspension expires. At that point, the Treasury Department will have to resort to extraordinary measures, cutting bill issuance and relying on cash reserves parked at the Federal Reserve to prolong its borrowing capacity until the debt cap is raised or suspended again. The debt ceiling has long been a favorite political weapon in Congress, with legislators often reaching agreements at the 11th hour. These standoffs typically send ripples through the front-end rates market, as investors sell off Treasury bills that are most vulnerable to a potential default, in favor of securities maturing later. "We expect the debt ceiling to go to the wire yet again," wrote Jason Williams, a strategist at Citigroup Incorporated, in a note to clients on Friday. "It is highly unlikely the debt limit will be the focus of the new Congress." Strategists from both Citigroup and Bank of America Corporation anticipate that the Treasury will have over $1 trillion in cash to deploy in the new year. This projection is based on a forecasted year-end 2024 cash balance of $700 billion and at least $300 billion in extraordinary measures at the department's disposal. However, these estimates are contingent on the size of the deficit the Treasury is managing. A larger deficit would reduce the time the Treasury has to operate effectively. Bank of America sees the deadline most likely coming in July, while Citigroup estimates that the Treasury can extend its capabilities deeper into the summer. Citigroup suggests that the department will probably aim for mid-June, before receiving corporate taxes. Adding to the complexity is the potential for distortions in short-term rates, which could obscure the money market signals the Federal Reserve monitors to determine whether it can continue unwinding its balance sheet, a process known as quantitative tightening (QT), without causing liquidity scarcity in the financial system. The Treasury General Account, TGA, functions like the government's checking account at the Fed, sitting on the liability side of the central bank's balance sheet. During a debt limit episode, the government spends down its cash balance, pushing more cash into the private sector, either in the form of bank reserves or balances at the overnight reverse repurchase agreement facility. Once the debt limit is resolved, the Treasury issues more T-bills to quickly rebuild its cash account, pulling cash out of the private sector and back into the central bank. These fluctuations lead Bank of America strategists Mark Cabana and Katie Craig to expect that the central bank will judge it prudent to end the runoff in late 2024 or the first quarter of 2025, at the latest, to avoid draining too much liquidity. Lower TGA will temporarily create a loss of money market signal or Fed blind spot in their assessment of abundant to ample reserves, the strategists wrote in a note to clients last week. The Fed likely won't want to keep draining and overdo it when losing the money market signal. As the Federal Reserve prepares to cut rates at its meeting this week, officials are expected to continue QT, especially since Chair Jerome Powell has indicated that rate policy and portfolio decisions operate on separate tracks. Writes an ICAP expects Powell to reiterate this stance. The debt ceiling debacle highlights the delicate balance the Fed must strike between managing monetary policy and ensuring financial stability. The prospect of a prolonged standoff over the debt ceiling could have far-reaching consequences, not just for the U.S. economy but for global markets as well. For ordinary Americans, the implications are profound. A default or even a prolonged period of uncertainty could lead to higher borrowing costs, market volatility, and a potential economic slowdown. For those professionally engaged in financial work, the challenge is to navigate these choppy waters with prudence and foresight. As we approach the critical juncture of early 2025, it is imperative that Congress acts decisively to address the debt ceiling. Failure to do so could have catastrophic consequences for the economy and the broader financial system. The Federal Reserve, for its part, must remain vigilant, ensuring that its policies are calibrated to maintain stability and support growth. For investors, the message is clear. Stay informed, stay nimble, and be prepared for volatility. The debt ceiling debate is a stark reminder that political brinkmanship can have real-world economic consequences. As we navigate this uncertain terrain, it is incumbent upon all stakeholders, from policymakers to investors to ordinary citizens, to work together to ensure a stable and prosperous future. In the spirit of David Brooks, we must remember that the health of our economy is not just about numbers on a balance sheet. It is about the lives and livelihoods of millions of Americans. It is about the strength of our institutions, the resilience of our markets, and the faith we place in our leaders to make the right choices at the right time. The road ahead is fraught with challenges, but it is also filled with opportunities. With prudent policy, careful management, and a shared commitment to the common good, we can weather this storm and emerge stronger and more resilient. That, after all, is the American way.